think the attractions of a US dividend strategy right now are probably twofold in the market. Firstly, just investing with dividend, and particularly with dividend growth in the US, has a really fantastic tailwind behind it. We know that over the long term, the US market generates a huge amount of wealth for investors. And about a quarter of that comes from the dividend, and 3/4 comes from the capital appreciation. Investing with this strategy that's not just about high yield, but also about growing dividends over time, gives us the ability to take part in both parts of that equation. We have a very powerful dividend premium that we offer our clients, and we also aim to grow that distribution over time by investing in businesses that grow their distribution as well. That gives us access to the capital growth part of the equation within the US and makes it a really powerful setup in terms of thinking about how to outperform over a number of years. The second part of the dynamic is that right now, this fund has a lot more flexibility than peers when it comes to investing in the US market. Because we invest across the market cap scale and across different sectors, and because we are able to invest in companies that have maybe a lower starting yield but have lots of dividend growth behind it, that gives us much more flexibility than a traditional dividend fund in terms of thinking about how to outperform the market. We can genuinely follow wherever valuations are in the market, and whenever different parts of the market become more or less attractive, we can trade in and out of those areas to try and make money for our clients, where a more traditional dividend fund tends to be locked into certain parts of the market more consistently. And then when you have volatile times, you can get very sharp periods of outperformance followed by very sharp periods of underperformance as well. What we aim to do on the fund is build you a product that yields somewhere around 15 to 30% more than the market. And by investing in businesses that can grow their distribution every single year, we aim to build a fund that is going to grow its distribution to you, the client, every single year as well. The target over the long term is to yield more than the market and grow that distribution significantly faster than the market. And we've delivered on both of those attributes over the last 10 years I've been doing this. Going forward, I don't think there's any reason to believe that won't be the case. And so the idea is that if we can do that consistently over time and by investing in businesses that are becoming bigger themselves, the fund will have a really significant and powerful tailwind behind it. The approach to stock picking is the majority of what we do on the fund. We have a fairly consistent 3-stage process around how we would invest in an individual holding, where we would, first of all, make sure that it meets all the attributes we're looking for on a quality basis and has the characteristic that we think that it can grow its distribution really quickly for a number of years in front of it. What that means in practice is that we're looking for very high quality statistics, and quality is defined there by returns on invested capital. We want to know that if this business has free cash flow and it can reinvest back in it to itself, that it will generate a lot of return for every dollar it does with that. But we also want those businesses to have the ability to grow very meaningfully into the future. And so for that reason, we also look for businesses that have a huge amount of opportunity to redeploy capital at those levels. So the example I always give to clients is a business like Coca-Cola, which has very, very high returns on invested capital and is found in many traditional dividend funds, but isn't a business that we invest in because we don't think it has an opportunity to redeploy capital and grow into the future. That is because the average American drinks somewhere in the region of 2.5 to 3 cans of carbonated soft drink a day. So there just really isn't an opportunity for them to sell more product. Alongside that, the third leg of the stool that we look for is a very powerful and meaningful dividend commitment. We want to know that having got the first 2 parts of this equation right, with a high returning business and a very obvious opportunity to grow, over time, we will get the benefit of a very powerful growing dividend alongside it. And the reason we're so focused on that is because we know that dividend growth is the transmission mechanism that pushes up share prices over time and gives us very good confidence to get a good total return out of our investments.